Don't let investing become the biggest mistake of your life. Art of Fortune. Don't let investing become the biggest mistake of your life. Art of Fortune welcomes you all. If you have already started investing or are planning to make more money, then you absolutely must watch today's video until the end. I will share with you a way to make money before you invest. Especially in the context of the gradually emerging economic recession. If you suffer losses and get stuck, what should you do? Actually, I've always been a positive thinker. When the economy was booming, many new investors could make money just by closing their eyes and buying stocks or Bitcoin. I was genuinely happy for them. But the problem is, unless the market stays in a perpetual state of growth, when a recession hits, the money they earned over the past few years could evaporate overnight. I don't intend to scare anyone, but recently I've noticed too many unstable factors emerging. Can those who have tasted the sweetness of the market endure the bitterness? A true investor doesn't just know how to make money during favorable times. Whether the market goes up or down, they can still earn stable profits, sometimes even more than usual. So, how do you become a good investor? Actually, the book Rich Dad Poor Dad taught us that you must have an investment plan. Sounds cliché, right? That's why many people don't understand and think it's just meaningless talk. But if you can do it, it becomes the truth. Let me explain further. A good investor is like a general. An investment plan is like strategy in Sun Tzu's Art of War. It all revolves around the concept of using strength to attack weakness. If today I have 1 million soldiers, and you only have 10,000, even with my eyes closed, I can defeat you. This is the principle of high probability. The goal of investing is to find opportunities with a high probability of success. How can you be sure you'll win before you invest your money? Even if the market collapses or a financial crisis occurs, it shouldn't affect you. If this video is helpful to you, please hit the like button. I want to emphasize that this channel, Art of Fortune, is dedicated to sharing the mindset for becoming entrepreneurs, business owners, and wealthy individuals. If you don't want to miss this important information, connect with me, subscribe to the channel, and turn on notifications. Have you ever wondered why top billionaires like Jeff Bezos of Amazon only have an annual salary of around $80? Or Elon Musk of Tesla doesn't even take a salary? Yet, their income per second is higher than the annual salary of most people in the world. Why? There's a truth you need to know. In the US and many other countries, the government requires all employees and business owners to contribute a portion of their salary each month to a retirement fund. This money is handed over to fund managers, also known as financial giants, for them to manage and invest. When these individuals control enormous amounts of money from global retirement funds, their investment decisions affect the prices of stocks, bonds, and other financial markets. This is why people like Bezos and Musk get richer and richer. Because they own real assets, millions, even tens of millions of shares of Amazon and Tesla. When you receive your monthly salary, a portion is deducted and indirectly flows into the pockets of these billionaires. And it's not just in the US. Any country with a retirement plan has a similar mechanism. Even if you don't work for Amazon, the reality is you are still making billionaires richer. This is also why, even though the stock market experiences financial crises, in the long run, it always grows. Because as long as people are working, money continues to flow into the stock market mandatorily. So, if you don't learn how to invest correctly and don't own real assets, you will always be exploited. But what is the true nature of investing? Previously, I shared about investing in real estate. But people always ask, what if housing prices fall? Firstly, if you look at housing prices in major cities, they are generally rising. Secondly, people asking this question are actually speculating, but they want to discuss investing with me. Although both involve buying houses, we are doing entirely different things. And the problem is, you think you're doing the same thing as me. This is the biggest mistake. Buying low and selling high to profit from price differences, that's business. A way to start from scratch. But it's not the goal of investing. If you use money to profit from price differences, you are speculating. A true investor pursues two words: cash flow, dong tian. In 2008, when the financial crisis hit, many people, including my family, bought houses. I was still young then. I witnessed them crying as they had to sell their home. When I grew up, I asked why they had to sell. They could only answer helplessly. There was no other way. Had to cut losses. Had to sell. At that time, the economy was in recession. They couldn't even afford the monthly mortgage payments. If they didn't sell the house, they wouldn't even have money for food. But one of my relatives was different. When housing prices fell by more than half compared to his purchase price, he didn't rush to sell. He even had money to buy more. And now, each of his houses has increased in value tens of times over. If I were his son, I probably wouldn't need to do business anymore. Just enjoying the assets would be enough to live on. When my parents heard this, they were very angry. Who would want to sell their house if they had money? I didn't say anything more but continued thinking. Why didn't my parents have money back then, while my relatives did? Clearly, they were both workers, doing similar manual labor jobs. Was that relative more hardworking than my father? From what I knew, my father actually earned more money than him back then. It wasn't until I read Rich Dad Poor Dad that I understood the difference between the two lies solely in those two words: cash flow. If everyone understood from the beginning that the world's richest people don't make money from salaries, but from the stable cash flow entering their pockets each month from workers' retirement funds, you'd see the picture more clearly. My parents bought a house just because they saw prices rising. They bought it to live in. When prices went up, they sold it to buy a bigger one. But my relatives were different. He rented out his house and rented a cheaper place to live himself. As housing prices increased annually, the rent also increased. Eventually, his rental income was enough to cover the mortgage payments. Before the financial crisis hit, the economy was still good. At that time, he negotiated with his tenants. Normally, rent was $2,000 per month. But if you pay 1 year in advance, I'll give you a 10% discount. If you pay 2 years in advance, I'll discount it by 15%. Thanks to this, he collected a large amount of rent up front. When the crisis hit, he didn't care whether housing prices fell because he could still pay the bank mortgage. While others worried about their credit scores and financial pressure, he continued borrowing money from the bank to buy more houses. Just 1 year later, housing prices recovered. So, who ultimately won and who lost? Whoever had stable cash flow won. Whoever didn't, lost. So, is real estate the only way to generate cash flow? Rich Dad Poor Dad teaches that if you are an employee or self-employed, you need to move to the level of a business owner and investor. But becoming a true investor isn't simple. You need capital. If you don't have money, how can you buy a house? If you don't want to move every year because the rent increases. If you don't want to be crammed onto buses or subways. If you don't want to live like a machine, going to work every day with income not matching your efforts, then you must build an asset with long-term cash flow. Most importantly, passive cash flow. In other words, while you are sleeping, traveling, or doing things you love, even if a financial crisis occurs, you don't need to worry about money. Stable cash flow is like the highest level of military strategy. Today, you bring 10,000 soldiers. I also bring 10,000. Both sides fight fiercely, making you think we are evenly matched and about to destroy each other. But right at that moment, my 100,000 reinforcements arrived. Does this battle still need to be fought? The sheer momentum alone is enough to make you terrified and lose. The game ended before you even realized it. Before engaging you, I had already calculated carefully how many soldiers you had and had also secured reinforcements from other countries. Learning military strategy isn't about becoming like Xiang Yu, defeating tens of thousands of Liu Bang's troops with just a few thousand. That story might be told for millennia, but it's an exception. What we need to learn is Han Xin's tactic of ants biting an elephant, where even a large elephant can be brought down. This is a strategy based on high probability. Similarly, investing must also be based on high probability. If a financial crisis occurs and housing prices fall, does it affect me? I wasn't making money from price differences in the first place. What I earn is cash flow. So, ultimately, the most important thing is still who has stable cash flow. War isn't Chinese chess, it's Go. One person cannot forever influence an entire group, but a group can certainly impact an individual. In battle, who wins? The one who knows how to concentrate superior forces. Only when my numbers are at least 5 times yours do I decide to engage. In the investment market, there are winners and losers. And ultimately, the deciding factor is still cash flow. If you have no cards left in your hand, but I still have plenty, how can you continue playing against me? Large capital determines the outcome. This principle never changes. But remember carefully, never gamble. I just want to propose a theory. If you go to a casino in Macau and play Sigbo, predicting dice rolls, and every time you lose, you double your bet. For example, the first time you bet $50. If you lose $50. But okay, the second round, you bet double, $100. If you win, you get back $200. Subtracting the $100 stake and the $50 lost previously, you still profit $50. Then, you continue using this profit to bet again. If you lose, you double the bet again. Third round $200, fourth $400, fifth $800. If you win in the fourth round, after subtracting all lost capital, you still only profit $50. But if you lose again up to the fifth round, you have to bet $1,600. Sixth round $3,200. And what's the problem? If you continue this strategy, each win only earns you $50. But when you lose, the betting amount increases exponentially. Many say if you have infinite capital, you can definitely win, because even if you lose 100 consecutive rounds, winning just one round gets your capital back plus $50 profit. But what's the issue? You'd have to bet tens of billions of dollars. Furthermore, the casino probably wouldn't allow you to bet that way. Theoretically, if you still have capital and stable cash flow, you can always make money. But the question arises, during a financial crisis, should you catch the falling knife? Buy the dip? Many say that during the 2008 financial crisis, when the whole world panicked, only the Oracle of Omaha, Warren Buffett, boldly bought large amounts of stocks, including shares of Bank of America and his favorite chocolate company. The result, 5 years later, he had earned over $110 million in profit. This is why many praise the classic investment strategy and suggest learning from Buffett to buy the dip. When I first started learning about stocks, I thought the same way. But then my university professor pointed out a problem. Example: today you buy a stock, and it drops. You think it's cheap now. So should you buy more? But if a year later, the stock price continues to fall, even more sharply, do you dare to keep buying? At that time, all my friends were losing money, including my parents. Everyone said the market decline was just a general trend. All stocks were affected. They advised me to have faith that this stock was undervalued, so I should buy even more. But what was the result? Initially, if the stock price dropped $1, I lost $1,000. But after buying more, if the price continued to drop $1, I lost $2,000. Why? Because I had increased my position size. I used higher leverage when the price kept falling and I no longer had capital to cover the losses. What could I do? After reflection, I understood two important things. First, when the entire market is in a downtrend, trying to buy in is like going against the current. If my goal is just to profit from price differences, I should buy when the price is rising, not when it's falling. I don't need to buy at the absolute lowest price. If the lowest price is $50, but I buy at $100, and then it rises to $130, I still profit. I might have bought at a higher price, but importantly, I still made a profit. Moreover, I only enter a trade when I'm certain the market is in an uptrend. It might take half a year for the price to recover from the bottom. But if I buy when the trend is confirmed, I can potentially make 5% to 6% profit in just 2 to 3 days. So, between catching falling knives in a bear market and trading with the trend in a bull market, which method is more effective and safer? I chose the second one. Second, the reason Buffett could successfully buy the dip wasn't because he was more daring than others, but because he had stable cash flow. Many think Buffett is an investor, but in another video, I mentioned he is actually a businessman. His company is the asset generating stable cash flow. This means if you invest in Buffett's fund today, regardless of whether the market rises or falls, you still have to pay him management fees. This fee is the stable profit he receives monthly. If you run a successful business with annual revenue over $100 million, investing a few tens of millions is nothing to worry about. Because if you lose, you can still cover it with hundreds of millions more from your business. If you lose another $100 million, what then? You take another $100 million to cover it. If you only have a few tens of millions, losing it all might drive you to despair, even contemplating jumping off a building. But if you have hundreds of millions, losing a few tens of millions is, at most, a bit painful. You can earn it back in a few years. So why is buying the dip investing for Warren Buffett, but gambling for you? Just because of two words. Stability, on den. He isn't afraid of losing. You lose once, and you're wiped out. He has reinforcements when going into battle. You can only fight desperately. Do you understand? The most regrettable thing is that you are engaging in speculation but learning investment skills. See the paradox? People often don't know exactly what they are doing. For example, everyone has heard the saying, "Don't put all your eggs in one basket." But Buffett advises you to put all your eggs in one basket and then watch that basket very carefully. It's the same concept of risk diversification. But many think they are discussing the same thing, while in reality, these two approaches are completely different. In the stock market, you should actually listen to Buffett. When the market enters a recession, most stocks fall. Instead of spreading resources thin, it's better to focus on one stock with the potential to recover earliest. But when it comes to asset allocation for investment, you cannot just invest in stocks. Real investing isn't about making money, but about protecting your assets. The 2008 financial crisis left many tragedies because so many people only invested in one type of asset without any other defense measures. For example, if war breaks out, all your stocks could become worthless paper. So, did you stockpile gold beforehand? If Bitcoin collapses, do you own a business generating stable monthly cash flow? Many ask me, how can I invest without money? If you are just an employee or wage earner, you cannot invest because you lack capital. Those with hundreds of millions can afford to invest 10 million. But if you only have 10,000, investing 1,000 is speculation, not investment. So why do many advise you to learn investing even without money? Because investing is for protecting assets. But if you don't have assets yet, what are you protecting? Therefore, I believe everyone needs a career instead of just a job. This career must follow trends because that makes success easier. When a financial crisis hits, it shouldn't affect your career. Furthermore, it must be capable of running automatically, providing passive income. Most importantly, the barrier to entry must be low. Currently, I see only one model that meets all these criteria: business on YouTube. More and more people are abandoning reading books for watching videos. More and more advertisers are pouring money into YouTube. When a financial crisis occurs, you'll still go on YouTube to watch videos, right? YouTube is now the world's second largest search engine with a massive user base. This means you just need a phone, microphone, and create quality videos to earn passive income from advertising over the long term. What's crucial is that even if you have no assets, just living day to day, a recession can still wipe you out overnight. Some recession triggers are unpredictable, such as geopolitical conflicts, escalating trade tariffs. Countries are frequently tense nowadays. And when tensions rise, they might use weapons to show force, causing major fluctuations in financial markets. Natural disasters are also unpredictable factors. So, what can be predicted? First, we need to monitor the yield on the 10-year U.S. Treasury bond. This is the most important indicator for measuring the health of the global economy. Simply put, when the U.S. government wants to borrow money from you and promises to repay in 10 years, they must pay a certain interest rate, yield. If more people want to lend to the U.S., this yield will decrease, and the bond price will rise. This is very important because the 10-year U.S. Treasury bond is considered a safe haven asset. Even if the U.S. went bankrupt, the recovered funds would prioritize paying bondholders first. Moreover, the U.S. is still the world's #1 economy with many intertwined international interests, making bankruptcy highly unlikely. Therefore, people buying U.S. bonds primarily do so to protect their assets. Why monitor the 10-year bond instead of the 2-year? Because those investing in 10-year bonds are pessimistic about the long-term economy. As I said, when the 10-year U.S. Treasury yield decreases, it means many people are buying. Does that mean the economy is about to enter recession? Not necessarily. Individual investors buying bonds won't significantly affect the yield. What truly impacts it is the decisions of large financial institutions, such as investment funds. When these institutions buy large quantities of 10-year bonds, the yield drops sharply, and that is the warning signal for an impending recession. Now let's look back at historical patterns. When a crisis occurs, the 10-year U.S. Treasury yield usually rises before the stock market crashes, then falls faster than the stock market. Examples include the dot-com bubble in 2000, the financial crisis in 2008, the trade war in 2018, and the pandemic in 2020. In all these events, the 10-year U.S. Treasury yield rose before the stock market collapsed, then fell before the stock market bottomed out. This is a simple principle of market manipulation. Large financial institutions need to lure retail investors into the market before they dump the bonds they hold, causing yields to rise and bond values to fall. Then they buy back the bonds at the lowest price. Do you understand? If not, it's okay. Just remember that when a financial crisis occurs, the 10-year U.S. Treasury yield tends to rise first, then fall. History shows that when the 10-year U.S. Treasury yield starts to fall after a sharp rise, that is the sign of a stock market collapse. I share this to warn those speculating in stocks. Monitor this bond yield closely. If it starts falling sharply after rising high, you need to be especially vigilant. The second sign to watch is whether the US dollar index, DXY, is rising sharply. This measures the dollar's strength against other currencies in the international foreign exchange market. Typically, during major turmoil or disasters, the dollar index surges because money flows to safe havens, and the dollar is the most trusted currency. I want to emphasize that true wealth isn't the amount of money you have, but the amount of time you can live without working. You can stop working but still maintain a normal life because you have a stable passive income stream. If you don't have stable cash flow, you are not an investor. You haven't even reached the level of a speculator. If you buy stocks just thinking they will go up, without a clear buy-sell plan, that's not investing, it's simply gambling. In investing, the most important thing is to have a long-term vision. Of course, every financial crisis, whether a stock market bubble or an economic recession, will eventually pass. The question is, how long can you hold on? Are your finances sufficient to sustain you until the market recovers? And more importantly, do you have the patience and mental fortitude to endure? It's all a test of endurance. Remember, first, you must build assets that generate stable cash flow. Then use the surplus money to invest. Once you have earned money, no matter how far the market plunges, it no longer matters much to you. Due to time constraints, we will pause here. Art of Fortune shares free knowledge on how to become wealthy, an entrepreneur, and an investor to achieve financial freedom. If you don't want to miss out, follow my channel, turn on notifications, and share this video with everyone. I also send my best wishes to everyone who liked this video. May you all achieve financial freedom soon. As long as you found one or two useful sayings in today's content that help improve your life, I am already satisfied.